Hello and welcome to Macros with Mythili, where we take a hard look at all the major macroeconomic issues before the country. Well, one issue that's been with us over the years and is unlikely to disappear anytime soon is that of financial inclusion, or rather the lack of it. More than 60 years after independence, only about 60% of the population has access to formal banking systems. This despite the fact that the RBI and the government have taken a number of steps to improve access, starting from bank nationalization to strictures on bank expansion in rural unbanked centers, to priority sector lending, to easier documentation for opening accounts, regional rural banks, local area banks, you name it. But financial inclusion remains a pipe dream. In a bid to change that now, the RBI has come out with draft guidelines on two new kinds of banks, payment bank and small banks. Will these succeed where others have failed? Joining me in the discussion are Subir Gokarn, Head of Research, Brookings India, Diwakar Gupta, former MD, State Bank of India, and Ashwin Parikh, banking consultant. Subir, let me start with you, since you've been in the Reserve Bank of India. Can we really mandate financial inclusion? Can we force it down the throats of people? Is it a case of which comes first, chicken or egg? Because after all, as incomes grow, people will want banking facilities. But right now, the problem is more that people don't have a savings, they don't have a surplus. So are we really trying to force the issue, forcing banks to kind of go into the rural areas where our experience really has not been very good? So what are we doing? Can we really mandate financial inclusion?
Well, I think we have to look at it in stages. The first stage is to just understand what the target segment is. Who are the people who we are trying to bring into the net? How are we going to do that? What are the kinds of things that they need? And all of that, I think, has been a process of discovery, sometimes successful, sometimes not so, over the last 4 or 5 years when this mandate has been particularly aggressively followed. I mean, you of course refer to historical process, priority sector lending and so on, but inclusion as it is now defined is really a 5 or 6 year old agenda. I think we are moving, we're in the early stages of that process. The second stage, which is now I think becoming visible, is once you've got a sense of what people need, the people who previously did not have access to the formal financial sector, how do we best deliver it? And I think that is where the sort of trade-off between existing organizations, existing institutions delivering delivering on this mandate versus trying to create a new set of organizations who may do the job more effectively, who may have different cost structures, different organizational structures, and most importantly use technology much more effectively because they are, they have no legacy on their technology front. That's the phase that we're entering into now, experimentation with different kinds of organizational structures, different kind of institutional mechanisms which will use a different combination of inputs to try and achieve the objective. Phase 3 will be then, spreading it out, taking the successful experiments, learning from them, scaling them up to achieve the target. So I think we've got to look at it as an evolution, and we are now entering phase 2.
Diwakar, Subir talked about various phases and said we're entering phase 2. But at the end of the day, access to formal banking, should it be demand driven or supply driven? Because even if you have banks, and you've seen there are so many banks in the public sector which have branches, but virtually very little business. So should it be that there's a demand for these services from the public? Because if you remember, not so long ago, the foreign banks never used to enter middle class, housing colonies. Whereas now when income levels have risen, they see a business opportunity there and they go there. So my question really is that should it be demand driven or supply driven?
Well, if you look at the growth model for the country, I think development has had to precede demand in several cases. Whether it was roads, whether it was power, so many things, you have to bring up the framework and then the demand happens. I think that the same thing happened with telecom. Now, as you enter phase 2, what are the statistics? Today you have about 9 crore accounts, all kinds of financial inclusion accounts, and 1800 crore corpus, an average of 200 rupees per account. You have 2.5 lakh touch points, and you have about, about 25 crore transactions. So either which way, in some respects, these are good numbers given the fact that effectively you had all this in just about 4 years. Mind you, phase 1 from 2006 to 2010 didn't really have a large number of transactions or accounts. So it's good, but how much is to be done? You today have an average of 3 transactions per account. 100 transactions a month for a BC, and these are not economically sustainable numbers. Now, if you look at the places where they are there, brick and mortar branches are 100,000 across 40,000 locations, and you have another 2.5 lakh touch points, you have 6 lakh villages. So, the demand is huge. But I think, as Dr. Gokarn also mentioned, the idea will be, and the success will lie in an alternate delivery model which leverages technology, is devoid of legacy, and can intermediate at 1/10 of the current cost to make it viable at subcritical levels as we know them today.
Ashwin, would you agree that it's basically we're looking for technology, new models, and ultimately you have to force the pace. Whether you like it or not, you have to provide people banks access, and then automatically they will start saving and putting their money in banks. Would you agree with that?
I agree. You know, the only thing is the approach seems to be very different this time. See, I mean, we've tried to touch the financial outsiders, you know, through 2 or 3 different mechanisms in the past. So we had no-frill accounts, for example, in banks. Public sector banking particularly went after that in a big way. The whole idea was that once you have, you know, an outsider, financial outsider, I mean, opening an account with you, then you will be able to grow the relationship across 4 phases as we traditionally have been talking about. Even Nachiket More committee, I mean, a paper talks about that. It talks about initially the account opening, then loans, and then buying insurance and pension from out of the relationship. To my mind, payments particularly, I mean, I'll touch upon the small bank a little later, but payments is a different approach altogether. What you're now trying to do is, we're trying to touch these customers, you know, through the telecom system particularly. I mean, there is a mention in the draft guidelines about, you know, other types of organizations also, particularly those who have large number of retail outlets. But I would touch upon the telecom first. I've seen in 4 other countries. Recently, I was invited by Sri Lankan a regulator to look at this particular piece more closely. Approaching customers and conducting their transactions through, MCOM and through, let's say, telecom companies is a very different idea. It's a very different concept. If they really start mobilizing savings in the process, you know, my first level of assessment from out of some of the people who are now talking to me about putting up their application seems to be suggesting that if you start with about 600, 700 points of presence in the first year, if you can conduct about 20,000 crore worth of transactions, just transactions, with just a small 5 basis points of, let's say, revenue out of that, and a spread of about 50 basis points on the savings that you mobilize, you know, then in the 3rd year you are through as a payments bank, and you would have covered much more, I mean, a much larger audience, you know, by way of that. So it's a different dimension altogether. I mean, taking from Subir's point and what Diwakar said, what you're now doing is you're approaching them through the transactions rather than just opening accounts. Small banks, to my mind, is a question mark. It's a big question mark because how will it coexist with universal banks is a question mark I have basically, Mythili.
Subir, even on the issue of payments bank, Ashwin talked about the remarkable experience of telecom companies, whether it is in Kenya, which is the most quoted example of M-Pesa. But in those cases, they were all nested payments, you know, banks. That means the telecom company tied up with a bank and then extended the facility. Whereas we're not thinking of that model. So is there not some kind of something that we're missing somewhere? Are we kind of rushing in the ideal of financial inclusion? Now, nobody can be against financial inclusion, but do we really need to have these telecom companies getting into becoming payments banks, or can they continue with the existing model where they have a JV with a bank?
What is it that people want from this? You know, what is it that the formal organized financial sector can offer the 40% or the 45% of Indians at whatever income level they are? What can they be offered? What is it that they need from the financial sector? And if you confine that discussion, which unfortunately I think there is a temptation to remittances, then you're bringing in this whole dimension of telecom companies and how effectively e-money and so on can work. But if you look at it in terms of a savings product, a credit product, an insurance product, a pension product, all of these are products and services that the financial sector should be finding a way to offer at those pricing points, at those ticket sizes, which I don't think a purely telecom driven strategy is going to provide. Now you got to really go out, understand the market, understand the risks involved in that particular area, and develop your lending strategy based on that understanding. These are both, I think, important ways in which you can take the larger requirement, the larger portfolio of financial services forward with new institutions, new technologies, and very cost efficient delivery mechanism. Some of them are bound to fail, no question. Let's not even worry about failure at this point. But we've got to be experimenting beyond telecom at this point.
Okay, so let's not get bogged down by any preset models. We have to experiment. But I'm afraid on that note, we have to slip into a very short break, but we'll be back very soon. Please do stay with us. Welcome back. You're watching Macros with Mythili, and we're discussing the idea of differentiated licenses, whether these can deliver the end goal of financial inclusion. Diwakar, just before the break, Subir was saying, let's experiment, let's try different things. But the point is, we have tried different things. We've tried regional rural banks, we've tried local area banks, we've tried private sector banks, we have old, new. I think we've tried almost everything, but nothing really has worked. So what is it that makes us more hopeful this time? Is it just a wing and a prayer that we're putting all our hopes on?
Well, that is really the biggest worry about the current guidelines. If you look at our past experience, you've had about 1,500 urban banks, 93,000 rural cooperative banks and cooperatives, and you've also had for about 15 years now this experiment of local area banks. Nothing has worked. I think the biggest problem why nothing has worked is not really so much because there are vested interests or it's a compromised solution. I think it's not worked only because we have tried to attempt recreating small banks just on the lines of the universal banks. And if we are talking about 600,000 points of presence, of which 500,000 are 2,000 population and below, it's certainly not going to work. So there are two things which give hope in this set of guidelines. The first is quoted as a constraint, but I think it could turn out to be a strength, and that is to say you cannot go out of a particular geography. Now supposing I am permitted to have a bank which operates in the northeast and in Maharashtra, I think I will gravitate naturally to wherever the bigger economic opportunity is. So the idea is to get somebody who is a son of the soil, local, and who intermediates right there. But I again make this point, and I do that repeatedly, if these banks try to intermediate just as the way we have known bank branches to be, I don't think it's going to be a great success. The future has to lie in partnerships. Lots of partnerships with telecom companies, partnerships with consumer durables and consumer companies like HUL, ITC, self-help groups, microfinance institutions, whatever.
Ashwin, Diwakar raised the issue of you need different kinds of instruments, different kind of modalities to reach the lower middle class and the people in the rural unbanked areas. But we have microfinance institutions, we have self-help groups, we have a host of primary agricultural credit societies, district credit societies, banks. So why do we need one more, or is it just adding to the numbers and hoping that somehow these will do something different from the past?
Yeah, I mean, I had indicated, that I'll come back to the small banks a little later. See, Mythili, the whole question is, you have three sets of people who are really essential to make an effective small bank. The first and the foremost is the economic community which you're going to serve. As Diwakar said, those groups of people who understand that activity can really serve those people. So the first stakeholder is present, let's say. The second is the stakeholder who's going to put the capital behind this. And the third most important is the skills, the banking skills, that is the kind of promoters who will come forward. Now, in the past, we had cooperative banking, for example, and members of the cooperative organization came forward, built a bank. We've seen that model working for a little while and then taking a different shape altogether. The skills essential or adequate number of promoters or managers to come forward and create small banks, lasting, those which will really be able to work on a longer period. So that's one question. How will these organizations coexist with the other universal banks is a larger question I always have in my mind. The banking is so highly cross-subsidized. The pricing is completely artificial. Now, in that space, for a small bank to go and find its niche or place, and collect savings at the local level, and then thereafter disburse loans, and with one economic upside or turn, then you have huge NPA and other issues. It's a question mark. Where is the capital going to come from? Where is the management? Which management are we talking about? Who's really going to come forward and create these small banks? and I mean, we know the community to be served basically, but that's all.
Subir, Ashwin also raised this very valid point that do we have a valid, viable commercial business model? Because if we don't, both in the case of RRBs and urban cooperative banks, there has been a cost which has been picked up by the taxpayer, because ultimately when these have to be restructured, the restructuring is done out of taxpayer money. So are we being blind to that possibility really?
Regional rural banks were started off with a different cost structure in mind, but very soon their union interests and so on, their bargaining power got them to equate wages and salaries with their parent, the sponsor banks. That completely undermined the cost structure. We've had all kinds of barriers that have come in the way of banks operating at sub-optimal scales, following the same basic business model. That's, I think, what we have to try and break out of now. So if you're looking at small banks, you're looking at payment banks, they really, if we try and just reconfigure bigger ones or scale down the bigger establishments, the bigger banks' business model to this, it's not going to work. I mean, let's just be completely, realistic about that. What we need to see is experimentation with new forms of delivery. And so let's look at ways in which we can configure resources, whether it's capital, whether it's human capital, whether it's technology, whether it's a physical branch network or something else. Find ways to leverage whatever is available to deliver at the pricing point that a person is willing to pay, and which makes it profitable for the entrepreneur. Now, bailout is an important issue for any banking system, but when you're looking at really small banks, I think the basic issue is once you've got deposit insurance, which has been offered in this model, you don't have to worry about it, because ultimately the only stakeholder who is unprotected in the system, because he's likely to lose his money for no fault of his own, is the depositor. If the depositor is covered, if we have effective deposit insurance, and most deposits are not going to run, in fact no deposit likely to run beyond the deposit once the limit once you have announced it, the deposit is covered. So there's no question of bailing out the entrepreneur, the shareholders here. They are going into it with their eyes open, with the possibility of bankruptcy.
Okay, there is no risk as far as Subir sees it, but on that note, I'm afraid we'll have to slip into another short break, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we are discussing the Reserve Bank of India's guidelines on differentiated bank licenses. Will they deliver the end goal of greater financial inclusion? Diwakar, before the break, Subir was talking about how he saw no risk at all. But if you look at the Reserve Bank of India guidelines, these small banks and payments banks have access to the interbank call money market. Now, this is an uncollateralized interbank call money market. So, is there not a risk? We did see in the case of even the financial crisis in 2008 that AIG was not even a bank. So, there are risks that one cannot just wish away. So, are we being a little naive in saying that there is no risk at all, just because in the case of payment banks, we tell them you have to invest in Government of India securities, because after all, even if you invest in Government of India securities, you could very well book a trading loss.
Well, as far as small banks are concerned, they can invest in only what are called SLR securities. They can only keep a very small float for their cash requirements and their balance on hand operations. So I don't think, though we are saying they have access to the money markets, I don't really think they have it in the spirit of the phrase. They will be investing in securities which are absolutely safe, and they won't be trading in them. So, on payments bank, well, payments banks will run a huge operational risk anyway, because they will be holding a lot of public funds. Let's remember that even though they will be paying and receiving, and therefore they will be netting out a cash position, the fact is that their liability is equal to the deposits they hold. And therefore, they will have to be very robust in terms of compliance processes, in terms of operational robustness, in terms of the checks and balances, including technology checks and balances.
Ashwin, if you can come to the guidelines, do you find the Reserve Bank of India talking in two voices? On the one hand, they're arguing very forcefully for differentiated licenses. On the other hand, we just seen them, IDFC is a niche bank. In fact, if at all there's a case for niche banking, it is in the area of infrastructure. But there the Reserve Bank of India has allowed a niche bank to become a universal bank. So does the Reserve Bank of India look a little confused?
Well, no, Mythili, I think it's the timing. What happened was, the universal banking guidelines were out and people applied. And then this entire, thought process of differentiated licensing and Nachiket More committee happened. So I think it is more like a timing issue rather than, I admit, I assisted, let's say, Department of Post at that point in time to do the application. Today, for example, I would have really guided Department of Post to look at Payments Bank more seriously, and become a niche bank kind of. So it's a matter of timing. At that point in time, there was no thinking, about Payments Bank and small banks.
Subir, if I can turn to you at this juncture and ask you a very fundamental question. Would you agree with the entire concept of using banks as an instrument of social engineering? You want financial inclusion, but that is something that government must deliver. Should you use commercial banks to try and deliver that? And if you do, why not use the post offices? They would be the ideal candidate. They have more than 1,55,000 post offices, almost 90% of which are in the rural areas. So why not upgrade technology in the post offices and use that as a medium to ensure financial inclusion?
I have absolutely no problem with the idea of multiple channels. I think it is tempting and sometimes legitimate to use existing business models, business organizations as channels of development. As long as it doesn't destroy the business, as long as it doesn't sort of completely undermine the business model, that some part of your business activity is oriented towards commercial or towards development activity, particularly if you have a monopoly, particularly if you have a license. Banking is not an open business. There are huge entry barriers to banking. So if you're saying, well, I'm letting you do banking, I've allowed you to jump over that barrier. So in return, you owe me something in terms of development agenda. I don't have a philosophical problem with that. As long as that development agenda doesn't completely undermine the economics of the model, I think that's where we've got to draw the line. There are many social benefits, developmental benefits from getting people access to relatively low cost finance. I think that's unquestioned. But where we must draw the line, must I think take a very realistic stand, is that you can't expect anybody to do this business if they're making a loss. If you want them to do that, then you have to subsidize them. If you're not willing to subsidize them, then let's not force the issue. Only large banks should do this, or only some kind of financial institution should do this. We have to have a playing field where there is a lot of innovation, a lot of experimentation, and entry is free. Now, I think one of the issues that we have to come to grips with is whether the 100 crore capital requirement is a bit too large. Is it going to prevent a lot of potentially very effective players from entering the field because they'll have to raise that much more money? So we should revisit these norms and guidelines as much as possible.
Okay, very quickly before we come to the end of this program, Diwakar, if I can just toss a question to you. So we talked about how banks must shoulder some of the responsibilities for development. But if you look at public sector and private sector banks, it is the public sector banks that have shouldered responsibility much more, number one. Number two, so we also talked about 100 crores as perhaps being too high, but you do need to ensure fit and proper. Can I have your response very quickly to this, because it's almost time to wrap up?
Well, I don't think I'll comment really on the fit and proper part of this, but the difference between the public and the private sector as far as financial inclusion effort and results are concerned, it ties in directly with the focus on profitability. For the model to make money, what we have been trying for the last 60 years obviously does not work. We have to discover a new model.
Well, I'm afraid that's all the time we have in this edition of Macros with Mythili. We come to the end of this very interesting discussion, but we cannot carry this on any further. Thank you so much for joining us, Subir, Ashwin, as well as Diwakar. Thank you also for watching, but we'll be back next week, same time, with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.